Earnings per share, free cash flow, and Warren Buffett's famous owner earnings. Understanding these is going to make you much better at analyzing and valuing companies, and to be honest, it's kind of just required learning if you're going to be a stock picker. Now, there are two kinds of businesses, and this is a quote from Charlie Munger. The first earns 12% on capital, and you can take that money out at the end of the year. The second earns 12%, but all excess cash must be reinvested. There's never any cash. So this insight from Charlie Munger highlights the importance of what you're about to learn in this video. And then Charlie gives an example as well and says, it reminds me of the guy who looks at all of his equipment and says, there's all my profit. We hate that kind of business. What you're looking at here is the basic structure of the income statement. And this is one of three financial statements that all public companies prepare for the public on a quarterly and annual basis. The other two financial statements are the balance sheet and the cash flows statement. And I will be doing an in-depth video into each of the financial statements sometime in the future, by the way, so definitely subscribe if you don't want to miss that. The income statement starts with revenue at the top, and this is the amount of total sales that the company has made in a particular time period. And at the bottom, after costs and expenses and taxes are deducted, we're left with net income. Net income is also referred to as net profits or net earnings or sometimes just earnings. And this is also the figure that is used to determine EPS, which is short for earnings per share. And earnings per share, or EPS, comes from dividing the net income figure by the company's number of shares outstanding. And then of course, shares outstanding is the number of shares the company's ownership has been divided up into. So here's the first lesson. It's important to know the difference between earnings per share and diluted earnings per share. Now listen, it would be logical to assume that if a company makes $1 million of net income and that company has 1 million shares outstanding, that it would therefore equate to an earnings per share amount of $1. However, there's these things called convertible issues, which include things like stock warrants, stock options, preferred shares, and convertible bonds. And now the details of each of them isn't important right now. However, what is important to know is that these convertible issues are able to be converted into shares of stock. When one of these convertible issues is converted into shares of stock, it causes the number of shares outstanding to increase, which therefore dilutes the percentage of ownership that each of the outstanding shares represents. Bad news for you as one of the shareholders because it causes your ownership percentage to shrink. So the takeaway here is that when you're calculating earnings per share or any other per share figure, you're going to be wanting to use this more conservative diluted shares outstanding figure instead of the normal shares outstanding amount, because the diluted shares outstanding number does fully account for all of the convertible issues that could be converted into shares of stock as well. You can find out the number of diluted shares outstanding a company has by looking at their financial statements, because all public companies in the United States have to disclose this number. Here's an example of Facebook's income statement for 2020. Right here, we can see that they have 2.851 billion shares outstanding, and then we can see right here that the diluted shares outstanding is 2.888 billion. And I'm saying billion, by the way, because these numbers here are expressed in millions, so some of the zeros have been omitted. And of course, when we take Facebook's net income and divide it by the number of shares outstanding, we get earnings per share of $10.22. But instead, when we divide the net income amount by the diluted shares outstanding, we get this $10.09 earnings per share figure right here. So it's not a massive difference when it comes to Facebook. However, there are some companies where it can be a big difference, and it's something important to be aware of. Typically, a company's management likes to focus on and spotlight that traditional non-diluted earnings per share figure because it's higher and looks better. However, when it comes to analyzing and valuing a company as a potential investment, it's definitely better to use that diluted figure, as this is going to be much more realistic to what is actually attributable to you as the shareholder. Now, by the way, if you're getting any value out of this video, please hit the like button below. It really helps out. All right, so this whole dilution thing that we've been talking about here is actually only one way that the income statement can be kind of misleading. If you're new to accounting and looking at financial statements, it would be easy to assume that because the bottom of the income statement tells us that a company has made $1 million of profit, that means that this is the amount of cash that could be distributed to the owners as a dividend, for example. However, that's not how it works. See, the income statement also includes non-cash expenses and even non-cash revenue if the company were to extend credit to its customers for them to buy something. As for revenue, it gets recorded when it's earned and not necessarily when it's paid for. So sales can be made and reported as revenue in a time period, but on the balance sheet, the addition gets added to the accounts receivable rather than as an increase in cash. Another thing that can throw off the income statement is when assets are sold. This income is income nonetheless, even though it's income that has nothing to do with the operations of the business. For example, if a building was sold and a profit was made, this would need to be reported on the income statement, and it would also increase that bottom line line net income amount, even though this is a non-business operations income that has nothing to do with the underlying business. So this is something that can also cause that bottom line figure on the income statement to be misleading. And as for expenses and how they're recorded on the income statement, let me give you an example. Let's say that a company purchases a new truck and it costs $100,000. Well, the full $100,000 is not what gets recorded as the expense on the income statement in the time period it's purchased, even though there was a $100,000 outflow of cash. How it works instead is that if it's assumed that this truck will last 10 years, the expense on the income statement will show up as a depreciation expense of just $10,000. Under the straight line depreciation method, the cost of the truck would be expensed over the 10 years of its lifespan rather than at the time it's purchased. And all of this is very fair and it all makes complete sense. All I'm trying to do is illustrate the point that that bottom line figure on the income statement isn't necessarily always going to be perfectly representative of how much money that business truly makes. And the truth is there definitely can be some accounting maneuvering, let's call it, that can be done potentially to even deliberately inflate or sort of misrepresent how profitable a company really is. If accounting maneuvers have been used to inflate net income, that would subsequently cause earnings per share to be inflated, and that would also have an effect on the PE ratio of that company as well. Warren Buffett has actually commented many times in the past about being wary of GAAP earnings as reported by the income statement. GAAP, by the way, stands for Generally Accepted Accounting Principles, and the rules of GAAP accounting are actually continuing to evolve even today. Alright, now let's look at a lesson that comes directly from Warren Buffett's 1986 letter to shareholders, where he reveals what he calls owner earnings, which he says is a much better number to focus on when it comes to valuing a business. And also, let me give you the context as to why he was giving us this lesson in that 1986 letter. First, it wasn't until 1988 that the cash flow statement became a required financial statement. So prior to that, public companies were only required to produce an income statement and a balance sheet for their investors. So when Buffett gave us this lesson in the 1986 shareholder letter, the cash flow statement as we know it today really wasn't a thing yet. So that's one thing to keep in mind. And then second, in 1986, Berkshire Hathaway purchased a company called Scott Fetzer. And so ultimately, the purpose of this lesson was to explain the real owner earnings in contrast to the reported GAAP earnings to all the shareholders that would be soon looking at the Scott Fetzer financial statements and analyzing the acquisition. So he starts by asking the reader to compare the income statements of two companies, Company O and Company N, and then quizzes us to determine which one is more valuable. So take a look. I've reformatted it, however, this is identical to how it's been printed in the letter. So you can pause the video here if you'd like to take a closer look, but in short, one has a bottom line net income figure of $40.2 million and one with $28.6 million. Buffett then reveals that they're both the same company, saying in the O, for old column, we have shown what the company's 1986 GAAP earnings would have been had we not purchased it. In the N, for new column, we have shown Scott Fetzer's GAAP earnings as actually reported by Berkshire. So then he continues by asking the reader which column presents the truth. Upon which set of numbers should managers and investors focus? Did the shareholders of Berkshire buy a business that earned $40.2 million in 1986? Or did they buy one earning $28.6 million? Were those $11.6 million of new charges a real economic cost to us? Should investors pay more for the stock of Company O than of Company N? And if a business is worth some given multiple of earnings, was Scott Fetzer worth considerably more the day before we bought it than it was the following day? He then goes on to explain what he likes to call owner earnings and then how to calculate them. And then he tells us that in spite of the GAAP accounting earnings for each of these companies, Company O and Company N, being different, that the owner earnings for both of these companies are identical. And here's how it's calculated. You take the reported GAAP earnings, you add back depreciation, amortization, and depletion expenses, as well as other non-cash charges, and then you make a plus or minus adjustment for changes in working capital, which is the change in the difference between current assets and current liabilities from one period to the next. And then from there, you subtract an amount for average annual maintenance capital expenditures. And what does maintenance capital expenditures mean? Well, it's the cost for things like machinery and equipment that the business must buy in order to fully maintain its long-term competitive position. The result of this equation would roughly tell you the amount of actual cash that the owners could truly take out of the business at the end of the year after the appropriate capital expenditures had been made in order for the business to maintain its competitive position. In other words, this is the amount of cash that could be distributed to the owners or could be reinvested in ways that would allow the company to grow. Remember, when Buffett wrote this 1986 shareholder letter, the cash flows statement as we know it today wasn't yet a financial statement estimate that was widely available for investors. So people will often ask, what's the difference between owner earnings and free cash flow? And the answer is that the idea behind both of these metrics is the same. How much cash is available to freely allocate? Whether that allocation is to be towards dividends, share repurchasing, paying down debt, investing, or acquisitions, how much cash is available for this? Let's take a look now at the basics of the cash flow statement so that I can explain how to calculate free cash flow. The purpose of this statement is really to supplement the income statement to make sense of how the actual cash is flowing in the business. So the cash flow statement is divided up into three main sections: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. And at the top, it starts where the income statement left off, with the net income figure from the bottom of the income statement. From there, we add back depreciation, depletion, amortization, other non-cash charges, deferred taxes, and make an adjustment for changes in working capital. The result is the cash from operating activities. And by the way, does this at all look familiar to part of the owner earnings calculation that we did earlier? So from there, we have cash flows from investing activities. Here we find the cash flows related to investing activities, which include things like capital expenditures, proceeds from the sale of property, plant, and equipment, any adjustments for the purchase or sale of marketable securities, and any other investing activity cash flows. The cash flows from investing activities is often going to be a negative number unless the company has been selling off a lot of their assets. And then the third section is cash flows from financing activities. This includes adjustments for issuance of new debt, repayment of debt, issuance or retirement of shares, as well as cash flow for dividends. The result of each of these three categories tells us the net change in cash in the time period for the statement. And then from there, we can add or subtract that amount to the cash balance of the previous period to give us the new cash balance. And this new cash balance is also what you'll find if you were to look for it on the balance sheet. Now, free cash flow is calculated by simply taking the cash flows from operating activities right here and subtracting the amount of capital expenditures. So this is pretty similar to Buffett's owner earnings. However, one of the limitations to free cash flow would show up if a company, say for example, made a large one-time capital expenditure purchase that would ultimately end up being depreciated over 10 years, but this will end up causing the free cash flow metric for that period to be unusually low. The main difference between free cash flow and owner earnings is capital expenditures versus maintenance capital expenditures. Buffett's owner earnings equation calls for us to subtract the average annual maintenance capital expenditures, whereas the free cash flow equation subtracts the entirety of the capital expenditures for that period. Companies don't need to separate out how much of their CapEx was for maintenance and how much of it was for growth, but there are ways to roughly calculate a company's maintenance CapEx. However, that's going to be outside the scope of this video, but it's worth knowing that it can be done. Ultimately, free cash flow and owner earnings are typically going to be pretty similar, with owner earnings typically being a little higher than free cash flow. And this, by the way, is why using free cash flow and free cash flow per share is going to be much better for valuation purposes over net income and earnings per share. If you've watched my video on how to calculate a stock's intrinsic value, you'll have noticed that I used earnings per share instead of free cash flow or owner earnings. And the reason I did that was just to keep things simple and not add any extra confusion while I was trying to explain the concepts of net present value and internal rate of return. If you haven't seen that video, I highly recommend you checking it out next. One thing I need to make clear right now is that there's no substitution for reading through a company's financial statements and understanding exactly what's going on and seeing how and where the cash is flowing, and seeing also how that compares from one year to the next and from quarter to quarter. When you're looking at financial statements, try to think of yourself as an investigator trying to figure it out. And sometimes you'll find that a company's accounting is way too convoluted and confusing to really figure out. And for those companies, you can just put them into the too hard pile and move on. Sometimes you might find wildly fluctuating amounts, and you'll want to figure out why that is and what caused it. Changes in working capital, which is the change in the difference between current assets and current liabilities from one period to the next, can sometimes cause large spikes and fluctuations from one year to the next. And you'll for sure want to investigate why this happened and what's behind it. Because if you're valuing a company, what you come up with will be worthless if you're using a base year that's very unrealistic because of some anomaly that you didn't take the time to actually completely understand. I'm not a financial advisor. I'm just someone who loves investing and loves business and loves to think about and learn about this subject.
You're right that there are people out there who will try to paint pictures with accounting that are something far from economic reality, and sometimes the rules of accounting themselves lead to that. I would say that when the accounting confuses you, I would just tend to forget about it as a company. I mean, it may well be intentional, and in any event, you don't want to go near it. We have never had any great investment results from companies whose accounting we regarded as suspect. I can't think of a one. Can you, Charlie?
No.
It's a very bad sign.
I made a short sale once that worked out well in a case like that.
Oh.
Charlie?
Yeah, asking Warren, what good books he knows about accounting would be, it's like asking him what good books does he have about breathing. And what the implication of that is that you start by learning the basic rules of bookkeeping, which are sort of like the basic rules of addition and subtraction. And then you have to spend a lot of time before that accounting gets related to the larger reality. And that's a lifelong process.